Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about investment questions of the week. Tyler and I get a lot of questions all week long, every week, and we just thought it'd be a good show if we just talked about some of the questions that come up from some of our clients, some investors that we might not work with, people that we hear from on the phone. So we're going to just talk about some of those questions as they relate to their investments. The first one we're going to talk about is we had somebody that wanted to know if they should sell their mutual funds because of the high fees. In theory and in general, yes, we like to see high expense mutual funds out of the portfolio. And part of the reason is, especially if you have a year like this year where a potential gain by the end of the year could be pretty slim, the last thing you need to do is have a loss on that particular investment in your portfolio because of the fees. So typically we like to have clients understand how fees are structured in mutual funds. But at the same time, there are some mutual funds that get a significant rate of return, might be beating their benchmark pretty significantly, but have some internal fees that are higher than we typically like. So do you really want to get rid of a mutual fund that might be costing you, 1.3% internal fees, but it's generating, 10 or 15 or 20% rate of return? So you have to weigh those things out. Tyler, what else do we look at when people ask us that question about selling the mutual fund because of the fee?
Yeah, Dean, and this is a very good question that we get from time to time. When people ask, should they sell their mutual funds because of high fees? The short answer is it really depends. And it depends on two things we need to wait, or what someone needs to do in a case like this is oftentimes you need to weight fees versus performance. And now keep in mind that with mutual funds, past performance does not dictate future results, but past performance of a fund can kind of give us an indicator of what the fund has done in the past, and we can utilize that to our advantage when we look at the fees that go into those. So with different mutual funds, oftentimes ideally, you want to get funds that perform well and have low fees at the same time. That is going to be ideal. But with mutual funds, there are some funds that have higher fees, and unfortunately, those fees weigh on the performance, where they drag the performance down due to the high internal fees. There are some funds that have 2 to upwards of 3% per year internal fees. And that means that you have to average 3% per year just to break even. So oftentimes we'll see that being the case, but other times, Dean, as you had mentioned, there are some mutual funds out there that average 1 to 1.5% per year internal fee. But if they've averaged 12% per year over the last 30 years, net of that fee, then there's other people that think, okay, well, if they're averaging 12% per year over the last 30 years after that fee is deducted, I can live with that. However, there are others who they would rather see a lower fee, and there's no one position that's either right or wrong. It's just something to be aware of, because there are other investments like ETFs or exchange traded funds that offer a cheaper alternative, but it comes with a price, and that price is not getting the active management from mutual fund managers. So if someone doesn't want high fees, then usually what we'll recommend are different exchange traded funds or index funds. With index funds, they follow an index like the S&P 500, the Dow Jones, the NASDAQ. There's a number of different index funds out there, but with an index fund, you have a very low internal fee because there's really no active management. There's no portfolio manager on Wall Street that is buying and selling stocks, because all those funds do is simply track the index. So it's a cheap way, it's an efficient way to get what the market is getting. But if you wanted to go above and beyond and try and beat the market historically, then you usually have to pick, they're called actively managed mutual funds. Now, with mutual funds, you're going to pay a higher fee with the actively managed ones, because buying and selling stocks trying to beat the index, usually they're going to charge a fee for that. But with that fee, you get the active management. You're not simply sitting in funds that are tracking the index. So what it comes down to is really there's no right or wrong answer, but what we would say is you want to weigh them against each other. Ultimately, you want to try and get funds that have low relative fees, but yet still have good performance. And one mistake that you don't want to make is you don't want to only look at the fees, because oftentimes there's people that they'll only look at the fees. And going back to my previous example, there are funds out there that have averaged 12% per year over the last 30 years. But net of that, and that 12% rate of return is after the fee, and that fee could be 1.5% per year. But after that, if they average 12% per year, you probably don't want to just scrap it just because of that fee. There's got to be a better reason than that. So you don't necessarily want to sell a really good performer due to only fees, but you want to factor those both in, where if you have funds that are underperforming the benchmark, then you probably want to take a look, and if those fees are higher, you probably do want to get rid of them. But if you have funds that are performing very well, regardless of the fees, then it's probably a good idea to continue to hold on to those. But ultimately, when it comes to selling mutual funds because of high fees, it really depends, where if you're not getting the performance, then you probably want to consider that, but you always want to weigh fees and performance, get low fee funds that have performed well over the long term.
Okay. The next question we're going to talk about, and we've heard this week, is should I only buy stocks that are way down? In March, of course, I think it was March 23rd, we hit our low this year. It was pretty significant, right around 34% down in the Dow year to date on that particular day. So that was pretty significant. We got the bear market that everybody was waiting for over the last 10 years upon us, and we're starting to get out of the back end of that. So when it comes to should I only buy stocks that are way down, for many people, this is just a once-in-a-decade opportunity. They haven't had this opportunity in a while. So they get into the mentality of thinking that if the stock is off 50, 60, 70, 80%, it's got to be a great buy. Well, that's not necessarily true, because if it showed downward momentum prior to this significant sell-off, and the sell-off has created, I should say the pandemic and the economy has created some weakness now within these sectors or the company, they might stay down for a long period of time. For instance, a lot of people are jumping on airlines and cruise lines, and we're not making a recommendation here, but what we're saying is, as an example, I don't believe cruise lines or airlines will really fully come back because of some of the damage that's been done by them not being in business for an extended period of time. Also, as long as this pandemic is with us and there's social distancing and people are worried about travel, they're going to continue to be depressed. However, if there's a vaccination, I think you're going to see those airlines and cruise lines jump pretty significantly. If you want to play that game, fine. We typically don't like to just bottom feed on stocks that are way down, because again, many times they stay down significantly longer than momentum stock. So there are some value stocks that are down pretty significantly. We like to see momentum stocks typically in a portfolio. What that means is, prior to a black swan event or a market downturn, you had some momentum that was positive. You had the trend going in the right direction. And then the downturn, market volatility brings down all asset classes. So they all came down. The stocks came down. In again, and they continued right out of the backside of this market downturn. So some of the momentum stocks you see out there would be something like Apple and Microsoft and Netflix and Amazon. prior to the pandemic, prior to the sell-off, they were doing well. After we hit bottom, they started coming back very strongly, and ironically are doing very well during shutdown process here in the United States. So don't always look at buying something that is just a great value because it's 50, 60, 70, 80% off. It might stay that way. The other thing is financially, they might not be able to make it. There are a lot of stocks and a lot of companies out there that they have enough cash and they have enough liquidity to take them through some part of a shutdown or slowing of services or sales. But if that starts to compromise, the bottom line, they're going to make some significant changes. They're going to lay off staff. They're going to cut dividends. They're going to do things that ultimately are going to reflect in their bottom line. So a cheap stock, because it's way down, could possibly even go out of business. So look at those things. Look at fundamentals. We love to see cash on the sidelines. You can find this information. Morningstar is one of our favorites that we go to review this information. You can see how much cash they currently have on the sidelines so they can weather a storm like this. Tyler, anything else about buying stocks that are beat up and just way down?
Yeah, Dean, this out of all the investment questions of the week, this is probably the most common one that I've gotten over the last handful of months here. But when we have clients that ask, should they only buy stocks that are way down? To reiterate what you said, right now stocks kind of fall into two separate categories. The first one we call bottom feeder stocks, and the second one we call momentum stocks. And Dean, I know you had touched on both here, but ultimately what I tell people is those bottom feeder stocks like your oil, your airlines, cruise lines. So again, we're not making any specific recommendations here, but you have a stock like ExxonMobil that is very beat up, something like Royal Caribbean, Carnival Cruise Lines, Delta, American Airlines, Southwest. So basically anything in those leisure sectors, airlines and oil, is considered bottom feeder stocks because they're beat way up right now. They're down very low. So it's a very good question because people always want to buy low and sell high. But ultimately what it comes down to is those bottom feeder stocks are a lot more work than momentum stocks. And what I mean by that is there's been days where people bought low, the stock went up 15% one day and then went down 20% the next, and then stayed down and just kind of went sideways. So they've got a net loss of 5% over 2 months after that. So really, if you're looking to buy those bottom feeder stocks, they're still super volatile. And with this uncertainty, sure, there are some days that they can go way up, but then if you wanted to try and make a profit and lock in that gain, then you have to follow the market every day and sell on one of those up days. And not too many people want to try and do that or want to try and time the market that way. So what it comes down to is until we get some sort of, or a little bit more certainty around travel and people going out more due to this virus, I think a lot of the leisure and travel stocks are going to be beat up, and they're gonna be very very volatile, and there's definitely going to be there's going to continue to be a lot of uncertainty around that sector. So it's going to be a lot more work if you want to try and manage them and make a profit that way, versus the momentum stocks like the Amazons, Apple, different companies like that. Momentum stocks are ones that had been doing well before this pandemic, and they're actually doing very well throughout it as well. Those are a lot less work because oftentimes momentum stocks are ones that are positioned very well for the long term. And those are ones that you can buy into, monitor from time to time, but know that you're buying solid companies and letting those ride. You don't have to do a ton of work and try and make a little profit and then sell it off. And you're not timing the market. You're not trying to buy low, sell high with those. Those are more of stocks that you just want to kind of buy and hold on for the long term. So what it comes down to when people ask my take on buying stocks that are way down, those bottom feeder stocks, if you wanted to do that, is probably going to require a lot more work on your end to try and manage those and make money off those. Whereas momentum stocks take a lot less work, and they're in sectors and industries that are positioned for good growth moving forward into the future. They don't require you to be as hands-on, but yet they're very growth oriented. So I tend to stick more toward momentum stocks, but either way can work. It just depends on how much more work you want to try and do to make money in each of the categories.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next question we heard this week is, should I make my portfolio conservative until the market gets back to normal? This is an interesting one to unpack. First of all, are we going to get back to normal? What people think normal is. This might be the new normal when we're talking about both the economy and the stock market. I mean, the volatility we've seen over the last year actually has been pretty significant. Now, volatility in the market doesn't always mean that you're going to end the year down. You can have a significantly volatile market or a year and still be positive. That's what we saw last year in 2019. In 2020, of course, it's been very, very volatile. And I don't really know what we could tell somebody about what, back to normal is actually going to be. So let's make the assumption that the market we're in right now might be the new normal. If that's the case, you have to be somewhat cautious when you try to make your portfolio conservative as the market is going down or is at the bottom. Here's where people make a mistake typically. They let their emotions kick into gear. They think they should go into more conservative positions, which would be bonds and some cash positions and maybe some more large cap versus international or small cap or emerging markets. But when do they do it? Unfortunately, close to the bottom, or as that slippery slope starts going down pretty significantly. Okay, now what you're doing is you're locking in your lack of ability to recover relatively quickly. So for instance, the old saying that the stocks that brought you to the bottom are typically the best ones to bring you back out. What they mean by that is many times not changing your portfolio into a conservative role or position to come back out is the best thing you can do. So again, understand that conservative trying to recover is not necessarily the right thing to do. Conservative prior to going into a market trough is probably a good thing to do. And you've heard me say this over the years. I seem to say it like every other show, and that is, please do not confuse conservative with safe. Yes, conservative portfolios will be safer, but it doesn't mean safe across the board. You can still lose money in conservative portfolios. We've seen that with bond positions in the past. Anything else there, Tyler, we should talk about when people are talking about making their portfolio conservative till the market gets back to normal?
Yeah, Dean, when people ask if they should make their portfolio more conservative when the market gets back to normal and loses a bit of the volatility that we see right now, really it comes down to when you're planning on doing that. And what I mean by that is we've had that question back on March 23rd when the market was down 40% in 3 weeks. And we've also had it recently here in late July, early August, when the market has recovered some and actually went positive since the beginning of the year. So you don't want to make your portfolio more conservative or sell stocks and go into bonds and cash on the way down or when the market's low. But what you want to do is ideally you wanted to have some set aside before the market goes down, so that way you aren't taking as much of a blow as the overall market if we see another downturn again. But the time when you do want to go conservative, if you indeed do decide to go that route, would be when the market has recovered and when the market's at a higher point as opposed to a lower point. So for those people who are retired right now and they were riding the wave of 2010 until 2020, the longest bull market in history, and they might have been a little bit overextended or a little too aggressive for their risk tolerance, they really felt it in March. But if they held on and didn't make any changes, now would be the time to get more conservative now that the market has come back and it's come back higher again, because again, it goes back to the old adage, buy low, sell high, and you ideally want to make changes and shift things around at a high point when the market is more, or when the market's at a high, to get more conservative. So one thing you want to keep in mind is if you do want to get more conservative based on the market, you probably want to do it when the market has climbed back up, such as right around now. You definitely didn't want to do it a few months ago at the low point, and if the market does take another if it does have another upcoming correction here, then you don't want to wait until the market is back down to try and make those changes and go more conservative. Because if you do, you're locking in your losses if you try and go more conservative on the way down. But the other thing that it does is it slows your recovery. And that's where, that's where a lot of people, they'll make knee-jerk reactions, and all of a sudden the market will go from heading downward and crashing to popping right back upward. And if they go conservative on the way down, then they're also going to be slowing their recovery a lot on the way back up. So just keep that in mind. If you do want to make your portfolio more conservative, the number one thing that I would say is you do want to consider where the market is right now, and you want to consider if you've recovered or not. If you have and actually made money, now might be the time. You definitely don't want to make major changes in the middle of market volatility when the market is heading down. You'd rather do it when the market's higher.
Okay, good points, Tyler. The next one we heard this week was have some extra cash. Where should I invest it? Okay, that's a nice situation to be in. But it all depends. It all depends what you're looking to accomplish with the cash. Are you looking for preservation? So in other words, do you have some money? You want to get better rates than CDs, but you don't want to take any risk? Good luck, because it's going to be tough. And the reason we say that right now is you look at, treasuries are very depressed. Fixed rate money situations like CDs, interest rates are at all-time lows. Fixed annuity products, all-time lows. So it's very hard to pick up interest rate right now in a low interest rate environment. Now, when interest rates are low, that's great for somebody who has a lot of debt because you're not paying a significant interest on that debt, but it's horrible for those people who are looking to save. So if you've got some extra cash, where should I invest it? If you're looking for yield, if you're looking to pick up something that's going to give you some growth, and you want to take some of the risk off the table, typically right now we're looking at large mega cap best of breed stock, US based stock. And part of the reason is we're at least able to get a decent yield through dividends. So if you can target a 2.5 up to 3-4% dividend yield, good for you. That's one opportunity. Do understand though that the higher yield percentage you're looking at typically means that the stock price is down or has been depressed. I brought this up in the past. I'll bring it up again. There's a company called ONEOK, and ONEOK is an LP pipeline company in northern Texas and Oklahoma region. And at one point, they had over $70 a share, and their dividend yield was about 2 to 3, maybe 4%. That's a nice dividend yield, even with the share price there. Well, right now their dividend yield is around 11% because the stock is down to 28. So understand that yield goes up when stock price goes down typically. Okay, stock price goes down, yield goes up. So when we have people right now asking where they can invest, we want to find out what are you looking to achieve. If you're looking for a place that is safer with your money, cash positions, it's going to be very hard to find a place that you can make a decent interest rate. If you want to take some risk with that, but reduce your risk compared to the rest of the market, you might look at large mega cap blue chip best of breed stocks here in the United States.
Yeah, Dean, really good point there. When it comes to investing cash with interest rates as low as they are right now, not too many places when it comes to savings, checking, money market accounts, CDs. But big blue chip stocks and stock mutual funds and ETFs oftentimes right now are going to be a pretty good bet if you can handle something in the market, and then also adding some bonds in there as well. So a good diversified portfolio with blue chip dividend paying stocks or stock funds, and then some bonds oftentimes right now is where extra cash could go. That's an option for some of the extra cash. And then the last question of the week, we've got time for one more here, is I moved some of my money in my 401k to money market and bond positions and lost money. How can I lose money in money market accounts and bonds? Now, this is one that we've gotten a couple months ago during a lot of the market volatility, and this week as well, we've gotten some of these, or some questions like this one too. But keep in mind, money market accounts and bonds are not cash. You can still lose in bonds, and that's what so many people, they don't know about that. They think bonds offer a fixed interest rate and they can't go down, but bond funds, they can still fluctuate in value. You can still lose money. During the crash back in March, the stock market lost 40% from the high point down to the low point on March 23rd in a month. However, during that time period, bonds were down 5 to 7 to some were down 10% or more during that time as well. So you can lose money in bond funds too. So just be aware of that. And Dean, that goes back to what you said earlier, where conservative does not mean the same as safe or guaranteed. Whereas bonds and bond funds, they are considered conservative, where typically they're not going to go with the stock market. They're going to cushion that blow a bit, but they're not safe. They're not guaranteed. You can still lose money. They can still fluctuate from time to time. The only place that's safe when we speak about the market would be just different cash positions as opposed to bonds.
Okay, good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.